Hello, and thanks for joining us this lunchtime for the Mortgage Solutions online masterclass in association with Skipton Building Society for Intermediaries. I'm Samantha Partington, freelance property journalist. Today's topic is the big autumn budget debate. After much speculation and the OBR's report leaked in its entirety just before the Chancellor stood to deliver her speech, there weren't many reasons to be cheerful about the package she delivered. A mansion tax and a rise in tax on income earned from property were two policies that will directly affect the housing market. Here with us this lunchtime to unpack all the budget news and what it means for the economy and the mortgage market are Jonathan Evans, Senior National Accounts and New Build Lead, and Ed Cowan, Senior Treasury Dealer Liquidity. To our audience watching, please do send in your questions using the Q&A button and we'll save them for the end. Jonathan and Ed, over to you.
Thanks, Sam, and afternoon, everybody. Hopefully you can see my screen, and that has popped up for you for our presentation today. So as Sam mentioned, we've got Jonathan and myself here today to talk around the budget. So without further ado, I'll get straight into it. So just in relation to the key announcements at a high level and the big news stories that we got from the budget before we get into the nitty-gritty of the individual changes. The main piece of news was that the fiscal headroom had increased to 22 billion. Given the message that we'd had from the Chancellor earlier in November, where she effectively prepared the market for the worst case, this was a lot better than expected. As such, the tax rises probably weren't as big as feared, and so the impact on economic forecasts was relatively minor. Growth is now higher this year but lower in future years. Inflation forecasts slightly higher, but actually we should note that the policies that the Chancellor has announced reduced that number down. So whilst it's good that there's no hole to fill, the way that she's gone about it is to effectively backload the majority of the tax rises. So it feels very much like she's kicking the can down the road a little bit. Between now and an awful lot of the policies going live, we'll probably have 2 or 3 more budgets. We could be in a different economic position at that point in time. We could have a different leadership within the Labour Party. And I think the other thing that's worth noting here is that from 2028 onwards, we'll start to move into an election campaign. And again, it's probably not a good timing for the Labour Party to be bringing in new tax rises. So I'm not saying that they're not going to happen. Obviously, it's very signposted that they will do, but Reeves will be hoping very much for better OBR numbers coming in future budgets to enable her to reduce or remove some of those. In terms of markets, they took it in their stride, and in the end, it probably was a little bit of a non-event, which is taken as a positive from a market point of view, given the uncertainty we had before. The market's main concern was that she'd have a disaster, and in the market's view, that probably didn't happen. Which means she probably continues as the leader of the, as the Chancellor, with Starmer remaining leader of the Labour Party for now. Markets very much look at this in better the devil you know, and I'll touch on that a little bit later on things to look out for next year. In terms of swaps, which, as many of you'll know, are the main driver of mortgage pricing for lenders like ourselves, they dropped slightly on the back of the news, which is, again, market taking it relatively positively, but they were only down around 1 to 5 basis points in the 2 to 5 year space, so relatively minor there. If we move on to the direct impact from the budget, mansion tax was the big headline, so that's on properties worth over £2 million. In reality, it only affects a small proportion of homes. I think the government listed that they thought it would impact around 100,000. Our data shows us that we think it's probably closer to 125,000, and 88% of those would be in London. So for those brokers with more focus on that high value area of the market, your risk here is that it will create cliff edges, with homes below the threshold gaining more appeal. But in relation to the size of the surcharge, given the prices that we're talking about here and the sums involved, the impact is expected to be relatively limited. The one other thing just to note here is that government have confirmed that the values will not be based on the most recent purchase price. Instead, the Valuation Office Agency will carry out those in 2026, but there is a consultation to come, so there's still quite a bit to learn on that one. The next one, buy-to-let landlords. So they will see a 2 percentage point increase in tax on their rental income if they are individual landlords rather than limited companies. So again, this is likely to be passed either onto tenants through higher rent. It could also see some individual landlords who make up the majority of landlords in the buy-to-let space exit the market. So again, whether that's pushed on through higher rents or actually reduces rental stock, are two possibilities there. Jonathan, I don't know whether you've got a thought on you're a bit closer to it than I am in terms of whether there's an opportunity here for brokers.
Yeah, so it definitely adds further pressure on landlords who own buy-to-lets in their personal names, and they do make up the bulk of the market. It could feel like a tax step too far for them. So if I was a broker, I would be looking at it as an opportunity to contact existing landlords and clients and really just understand if they're now looking to convert those buy-to-let properties into a limited company and discuss the available options to them at this point in time. And we know that this side of the market is an increasingly growing part of the market. More lenders are entering into the SPV and limited company space. Or secondly, I'd be looking at ways to help landlords who are potentially thinking about disposing assets and taking advantage of, for example, Skipton's track record proposition, as this could help landlords achieve up to 100% market value and sell the property to their tenant without the tenant potentially not having to need a deposit. So yeah, there's definitely opportunities here if brokers were to think how they could best help their existing landlord clients, but also look at ways how could they access landlords looking to dispose, and how can they get access to tenants to discuss potential ways to help them with fixed rate mortgages versus the uncertainty of increasing rents.
Thanks, Jonathan. So a couple of other things that came from the budget that should impact directly on housing market. The Chancellor announced that she would consult the market on a new first-time buyer savings product. So currently we've had the Help to Buy ISA. We're now with the Lifetime ISA. So she's potentially looking to introduce something new there, dependent on the details. That potentially could make it more affordable for first-time buyers to buy their first home. So I guess we'll watch out for any further details on that. And then the final one was just around training and free training for apprentices. So that's been extended out to under 25s for small to medium-sized businesses. We know from a builders building sector point of view, the SME builders have been hit very hard in recent years with thousands going under. And so this will be seen as a positive for them and may help to boost the smaller development, new home stock. I guess it links in nicely with the government's aim to increase the skills workforce in the building sector by 400,000 during this parliament. So that's direct impacts on housing market. I've just listed a couple of indirect impacts here as well. So the cash ISA limit is changing. So why am I mentioning this to a group of brokers? Well, this potentially does impact the composition and cost of the funding base for lenders like ourselves. It's probably more of an impact on the building society sector that rely more heavily on cash ISA funding. So Skipton, for example, we take around 50% of our funding through the cash ISA market. Thankfully, they've left over 65s as they were, but under 65s previously were able to deposit 20,000 with us tax free, and that will now be only 12,000 when these rules come into place. So that 8,000 that we potentially lose will need to be replaced and possibly through more expensive channels. So that then either has to be swallowed by the business in terms of lower P&L from our side, or depending on how the market moves, is that then passed on to mortgage customers through higher rates? So again, one just to watch. And then the other thing I think is just worth pulling out, there's a number of other policies that are not directly linked to the mortgage market, but the likes of freezing income tax and national insurance thresholds, the salary sacrifice scheme, and reducing pension contributions that are not subject to national insurance to just 2,000, increasing tax on savings and dividends. They're all in effect a stealth tax that will mean that in time people will have less less money in the pocket, less disposable income, which potentially has a negative impact on affordability. But I will caveat that is future. And again, Jonathan, I know we were chatting yesterday around, you've been looking at some numbers around affordability and mortgage approvals at this current time. Is there anything you wanted to update on that?
Yeah, so I'm not saying it's going to offset it completely, but to offset that, in terms of affordability, we have seen stress rates reduced this year. LTI flow limits have changed this year. Lenders are becoming more competitive in that space, with a number of the top 10 lenders now offering more than 5.5 times income, and a plethora of other lenders who are offering 6 and 7 times income. In addition to that, you've got wages that are ahead of inflation, combined with more recent muted house price growth. And Lloyds Banking Group have released some data last week, which basically shows that the house price to income ratio is the lowest it's been in the last decade, since 2015. And also within group, we've got some good Skipton group data, which also shows that we are seeing a higher percentage of solo first-time buyers buying in their own name rather than a joint application. So we're effectively seeing more solo first-time buyers buying in 2025 than there were in 2024. So yeah, quite a few positives there in terms of first-time buyers and affordability.
Thanks, Jonathan. And what does that mean then from an economic outlook point of view? So the honest answer is that our forecasts haven't really changed a great deal on the back of it. As I mentioned before, swaps dropped slightly, but in comparison to when you look back at something like the mini budget, where we saw moves of hundreds of basis points in the aftermath of the mini budget, we moved 1 to 5 basis points lower. And actually, if I look today, we're probably about where we were pre the budget. So markets have really taken it in their stride. From a base rate point of view, and I will just caveat that our current house view was done back in September, so it is a little out of date. Our view is that we see one more cut in Q1 next year to 375, which will be the low point. But probably looking at the market view is more interesting at the moment. We've seen that change in recent weeks following the 5-4 vote to hold rates in November. The market is now pricing in a 92% chance of a cut in December. And actually, I think the analysis is quite easy to look at the moment. You're effectively trying to guess what Andrew Bailey will do and nobody else. So as you'll have seen in November, we had 4 that voted to cut. They are very likely to do the same again in December. We had 4 that voted to hold, and again, they're very likely to do the same. And the one person occupying that middle ground is Andrew Bailey. So he's trying to decide exactly what he will do. Since that last meeting, we've seen unemployment has increased slightly. We've seen wage growth dropping slightly, both pointing towards a loosening in the labour market. We've also seen inflation peak in September and begin to trend downwards in line with the Bank of England's forecasts. So that data should be nudging Bailey towards a cut. We do get one more inflation print the day before the meeting in December. So the meeting, I think, in December is on the 19th, the Thursday the 19th. Is that the right date that I've got? Let me just check. Thursday the 18th of December. So we get inflation on the 17th. So watch out for that. But my view is that he will vote to cut, and the Bank of England will therefore cut rates to 375 in December. Picking up on a few other metrics, unemployment is now at 5%. We think that's around where it will peak, although it has got there a little faster than where we were expecting. So the risk is to the upside there. Inflation, as I already mentioned, peaked at 3.8%, and we expect that to trend downwards gradually, hitting the Bank of England's target in 2027. House prices probably a little bit more interesting for those on the call. We started the year very well, but we've certainly stagnated in the second half of the year, and I think that's particularly down to the uncertainty around the budget. We expect them to flatline into the year end, which will mean growth for 2025 of around 2%. We think that will pick up a little bit in 2026 as we see some of that uncertainty unwind. What's now more uncertain is the future years of the forecast. We would tend to be more optimistic in later years, but the fact that the Chancellor has announced that an awful lot of her fiscally constraining policies are going to come into play later, actually that may also constrain the housing market in 27 and 28. So Again, we're probably expecting somewhere between 2 and 3% growth, compared to, if you'd have asked me 2 or 3 weeks ago, it would probably been closer to 3 to 4% growth. I think I've got a slide in here as well that just shows the market and Skipton's view. As I said, Skipton's view is slightly out of date, but the green line is where the market is expecting base rate to move. We see a full cut priced in for February, a further cut in June next year, and then we start to increase from the 3.5% bottom level in 2029 from a market point of view. I put this slide in. I think this is a really good slide to show the broker network, and I think if there's one thing you take from anything that I say today to go back to your customers, this is probably it. The blue line, if we focus probably on the right hand side graph, the blue line shows the 5-year swap rate. The white line shows a 2-year swap rate. So as a reminder, banks and building societies use swaps to price their mortgage products. It's one of the main drivers of how we price a mortgage product, and it's effectively trying to predict at a point in time what the average base rate or SONIA rate will be for that period of time. And the orange line is base rate. So what I'm trying to show here is that since the Bank of England began cutting rates back in 2024, we've seen 125 basis points of cuts. During that same time, the 2-year swap rate's only dropped by 75 basis points, and the 5-year swap rate has only dropped by 10 basis points. So I think mainstream press are not very good at this. You'll see the Bank of England will cut rates, and the first thing that's out on BBC is relief for mortgage customers. Well, the only relief it's for is someone on a base rate tracker. It's not really it's not relief that's immediately flowing through to fixed mortgage rates. If the market and therefore swap rates expect that the Bank of England are going to cut rates, so December is a good example, 92% priced in, and they do cut rates, then swap rates probably aren't going to move a great deal, and therefore your mortgage rates probably aren't going to move a great deal. What will move your swap rates is when something happens that the market is not expecting. So if the bank the bank are currently expected to cut, if they don't cut in December, then you'll probably see a little bit of a correction, and you could even see mortgage rates tick up on the back of that. So message here from me is just because base rate drops doesn't mean that your mortgage rates are going to drop.
And I'll come in here as well, Ed. So the Bank of England done some research, and the average mortgage rate paid in the UK changes only every 3.5 years. So even if the bank rate did drop to, for example, ahead of where the market's expecting, let's say it dropped to 3% by the end of 2026, the average rate paid would still be around 4% by the end of 2027. Unless more borrowers switch to a shorter term or more floating interest rate, because we all know the go-to for UK customers tends to be a fixed rate, yet the majority of them. So it's just worth considering when you're having those conversations with clients.
Thanks, Jonathan. No, yeah, it's really good insight, that. So I think I've got one slide left, which is just in relation to my view on other things to look out for in the next certainly 12 months. Arrears, I've talked about this for probably a number of years now. I nearly took this one out, but I think it's still worthwhile touching on. We haven't seen an increase in arrears on the back of the majority of mortgage customers refixing to higher rates from the lows that we were on pre-COVID. The vast majority of those that were on 5-year fixes are coming up in and around now to refixed. We don't expect that to spike, and therefore we don't expect to see any significant default rates there. So that should be a positive. The next one, changing Labour government. I've added this in. This is an interesting one. If you're looking mainstream press at the minute, Reeves is really getting quite a lot of heavy criticism, particularly from other political parties. I mentioned at the beginning, markets took her budget as relatively okay because she didn't make a real mess of it. Markets are probably more concerned that if she was to be forced out and Starmer to be forced out, if you think about Starmer and Reeves, they're probably as central as you'll get in a Labour Party, and anyone that was going to replace them would be further to the left. And that again, if you're looking back at historic Labour parties, if you're further to the left, that means probably more borrowing, more spending, more debt, which means that they on the back of more borrowing, gilt yields would move higher, which makes it more expensive for the government to borrow cash for their policies. And it also is inflationary, which would mean that base rate potentially has to be higher and therefore mortgage rates higher. So I guess watch this space there. The view was that she got through the budget. What's now happening is an awful lot of negative press around has she misled the government and the country with a statement at the beginning of November by saying that almost there would be a black hole and then there wasn't. So we'll wait and see how that plays out. Key player strategies. Again, if we think about the bigger banks, we would tend to see historically the likes of a HSBC and a Barclays tend to be running long liquidity positions, which means if they want to get involved more and be more competitive in mortgage markets, they could do. On the sort of other side of the coin, Lloyds and Santander would tend to need to do that they would tend to need to fund to be able to increase their lending more than they probably already have in plan, which would mean being more competitive in savings markets, which probably gets swallowed by businesses in terms of margin compression, but could feed through into higher mortgage rates if there's a pass on. Donald Trump. Well, who knows with Trump, whether it's tariffs, whether it's conflict, anything goes in effect, and therefore that creates uncertainty, which gilts and swap markets don't like. That creates volatility, which means that mortgage rates potentially having to move around more. It might mean that we see our mortgage pricing teams need to price more regularly so that we don't take big exposure against potential for someone like Trump to come out and say something that shifts markets against us, and therefore you may see that pricing or repricing is more regular. And I appreciate that may be a bit more of a pain for you in the broking market, but we're doing it because of the volatility in the market if you do see that. And then a black swan event is, who knows, something will happen in the next 12 months that nobody saw coming, and it will impact swap markets and therefore will impact mortgage pricing. And I think that's everything I was going to say in terms of presentation today. So I'll pass back to Sam to look at any of the questions that we've had on the Q&A.
Thank you. Thanks very much to the Skipton team there. That was a really interesting presentation, packed full of insight and also practical suggestions for the mortgage broker community. We've had some questions come in already, so I will dive straight into those. Ed, now that the budget is out of the way, do you think we'll see a pickup in buyer demand come January? I thought maybe we start with Ed and then we'll move on to Jonathan.
Yes, I think is a short answer, Sam. The data that we have from within our group of companies does show that we think that there is some pent-up demand. Just a few examples. So I think in Q4 25, the typical home going under offer is on average taking 7 days longer. And then if we look more specifically at November, the slowdown was more pronounced, with average homes taking 83 days to go under offer compared to 72 this time last year. And I think it's also worth we've touched on the mansion tax as well. So in relation to the area of 1.5 million to 2 million properties, in the 30 days to mid-November, one of our teams had a look at this, and applicant inquiries dropped 53% on the same time last year. So our take of that is that there's an awful lot of, because of that uncertainty, people have held off, and therefore let's get through Christmas. And our hope is that we'll see that pent-up demand come through in early 2026, and should be a decent time for brokers. Jonathan?
Yeah, and just sort of following on at that, when you look at mortgage approvals in the UK, since April, the mortgage approvals have rebounded post the stamp duty changes after the last budget. So this shows the underlying resilience and strength of the market. Yes, it's tapered off slightly in the last month due to uncertainty leading up to this budget and some of the leaks that were coming out. But now that the budget's been delivered, it gives the mainstream market clarity, the clarity that it needs to move forward. So there are signs of pent-up demand, as Ed sort of mentioned there. So I think as an industry, we can expect a modest pickup in activity going into 2026. And also when you zoom out and look at mortgage approvals over the last decade, UK mortgage approvals for purchase transactions are now back to similar levels of where they were 5 years leading up to COVID, which again is another positive in the underlying fundamentals of the market.
Okay, interesting. You mentioned in one of your slides about the base rate, that the Skipton house view, Ed, is that base rate to bottom out at 3.75. You did caveat that with it being a little bit out of date, and that the market is 3.5%. One of our audience members wanted to know what your view was.
Okay, interesting. It's a very interesting question, and I will just state that this is my view. This is not the Skipton's view, but I think there's a real risk to the downside here that we'll get more cuts than certainly Skipton and the market are expecting. One thing that came out in February from the MPC meeting was that the Bank of England advised that what they deem their new neutral rate to be is somewhere between 25 and 75 basis points higher than their previous normal neutral rate. Now, the previous rate was 2 to 3%, so that in theory means we're somewhere between 225 and 375. So even if we're getting down to 375 and 3.5%, we're right at the upper echelons of that range. The other things that I'm looking at is OBR forecasts, so growth relatively unchanged, but it's still weak really throughout the next few years. They also downgraded our productivity expectations, which is quite key for driving growth. And to improve that, we need to try and increase savings and business investment, which this budget doesn't really incentivize. So all in all, from my point of view, if the Bank of England can control inflation, which their forecasts show that they can, I think it gives them some more scope to try and boost the economy by cutting rates deeper. So I wouldn't be surprised if we saw 3.25. I wouldn't be surprised if we even got to 3% next year. That's probably a little bit of an outlier from maybe other economists and other people in the market. But yeah, I think there's definitely risk to the downside.
Okay, interesting. Jonathan, I wanted to come to you for this next question. The audience were keen to know which budget announcements could impact, and I'll group some questions together here, but impact mortgage lending volumes or house building volumes, either positively or negatively next year. So any of those announcements going to have an impact on those volumes?
I think, to be honest, a lot of the announcements specifically for the housing market, I don't think they'll be strong enough to make any significant changes. So I think it'll be quite marginal. So it's almost, BAU, get back to what we're good at as an industry and help customers navigate the complexities of the market. Sometimes I think it's what's not said that matters most. So the absence of a new Help to Buy scheme will disappoint house builders. And Leaf House first-time buyers, support for first-time buyers from the government largely unchanged. But as I said, we've already touched on the positives. The underlying market will carry us through. When you look at mortgage approvals, it's shown that the market's resilient. Affordability is in the best place it's been for first-time buyers in a decade. And you've also got the other thing that I forgot to mention earlier actually was you've now got a regulator. The PRA is obviously taking feedback from the sector and allowed lenders to do a pilot on our flow limits for LTIs, which has helped customers with affordability. But you've also got the FCA, who published a consultation paper earlier this year, DP25. And again, that's looking at ways that we can help, looking for the ways the sector can help underserved customers and help more first-time buyers and customers with irregular income types. So for example, self-employed, 0 hours contractors, etc. So I'd say the budget, there's been a lot. Wouldn't say there's anything significant there in terms of going to impact what we're going to see next year. But as I say, sometimes it is the things that are not said that matters the most, but we can't have it all. And as Ed pointed out earlier, there's still a couple of years left in this parliament. So hopefully we will start to see more changes that will help house builders and will help first-time buyers more in the coming years.
Okay. Got a question on mortgage rates. I know Ed, you did cover quite a bit on swaps and possible mortgage rates, but just to cover this one off in its entirety, what impact do you think any of the Chancellor's announcements will have on the direction of mortgage rates in Q1 and Q2?
So I think, as I noted in the presentation, actually markets took this in the stride. They didn't swaps didn't really change a great deal. So on the back of the actual budget announcements, I don't really think it changes the landscape that we're in. I think on the back of the question that you asked me previously, if I'm right, and I think that the Bank of England could cut rates more than the market are expecting, as I shared on one of the slides, if the market is, or if the changes are different to what the market's expecting, then that will move swap rates, and that will therefore move mortgage rates. So if we do see the Bank of England cut more than the market's currently expecting in February and June, then I would expect that you may have some chance to see mortgage rates or swap rates, and therefore mortgage rates drop slightly. But as I've said previously, is don't just base your view on the fact that if base rate drops, therefore, mortgage rates will drop by 25 basis points. That then they're not linked in that manner. It's more on the expectations. So I think there is some scope for mortgage rates to come slightly lower, but don't be expecting massive movements.
Okay. Jonathan, I think this is probably one for you. Given the budget hasn't really delivered anything significant for the housing market, as you mentioned in the presentation, the mansion tax isn't going to affect a huge amount of properties. Obviously, there is the increase in income tax for landlords. What opportunities are there for brokers going into 2026?
Okay, so when you look at the maturities market is estimated to be around 350 billion in 2026. Then when you add in the purchase transactions, brokers have got over £500 billion to go at. So there's definitely a market out there if the broker's willing to look for the business and adapt what they're doing. This year in 2025, roughly about a quarter of all maturities were first-time buyers maturing for the first time. So I'd expect that trend to be similar, maybe not as high, but similar for 2026. So again, it's really important. The brokers are the trusted advisor for the customers. Put your arm around your customers and help them get through that first maturity. Because a lot of these first-time buyers, they'll be maturing for the first time ever, in a market that's been quite volatile. Other interesting part that I wanted today is about maturities, just for some stats out there to really highlight the opportunity. Bank of England have released some data. So what they're saying is between now and the end of Q4 2027, roughly 50% of maturities are expected to refinance onto higher rates. 31% of them will refinance above 3% for the first time ever. 5% will experience an increase exceeding £500 a month. And then you've got the lucky ones, the 27% of mortgage holders that will see payment decreases. And I know this might be a bit late in the day because we're already into December, but December, you've got a massive maturity month right now of 43 billion. So, normally most of these customers would be contacted months in advance, but if you haven't, there is still a lot of maturities to go at in December. In terms of outside maturities, it's a really competitive lender market. Okay, so unemployment has ticked up to 5% in the last couple of months, but historically unemployment is still relatively low. House price inflation, when you look at, for example, Savills, they're forecasting house price inflation to increase by about 22% over the next 5 years. So those conditions make it good for lenders to lend. We want to lend money, and I really do think you're seeing that. Yeah, you've got more and more lenders being more competitive. So for example, on new build, you've now got about 58, 60 lenders that will do 90% loan to value on a new build house. You've got around about 30 lenders that will do 95% on a new build house. And you've got about maybe 10, 11 lenders that will do 95% LTV on a new build flat. And obviously Skipton are one of them, as well as a handful of other decent lenders. You've also got visa applicants, record levels of immigration into the UK. You've now got more and more lenders who are offering up to 90% or sometimes higher loan to values for these applicants because these people need somewhere to live with their families. And as I mentioned earlier, you've got the LTI changes, which is, it is helping affordability. And on top of that, you've got lenders like Skipton, and there are others out there that are bringing out innovative products. We don't always need regulatory changes to push the boundaries, that there is freedom within the framework in which we operate. So there's a lot of opportunities for brokers out there, and you throw into the mix the landlord opportunities that I'd mentioned earlier. Yeah.
Thanks, Jonathan. Just to take it back to the economy and political sense as well, Ed, why would the Chancellor have chosen to still tighten fiscal policy when she knew the buffer was going to be bigger than expected, something that she's coming under fire a lot for in the news at the moment?
Yeah, very good question. My answer, sort of working in markets, would be that she's needed to keep the gilt market happy. As we look back at something like the mini budget, when that's exactly what didn't happen, and gilts ran away, yields went too high, which effectively meant the end of Truss and Kwarteng. Gilt yields, just a reminder, that's a cost to the government to raise new debt for what Reeves wants to spend that money on. So it's very important for her to keep those well behaved, keep yields from increasing significantly. So by not increasing borrowing significantly and building in a bit more of a buffer with extra taxes, markets can almost see that as she's being a little bit more fiscally responsible. And again, there may be people on the call who sit there and thought that her budget was a disaster and a waste of time, but from a market point of view, she didn't do anything that added significant uncertainty to markets. So by doing so and keeping herself a little bit of a more of a buffer in place, that's seen as a positive. I think the other thing that's worth just noting here is that you can have volatility in certain metrics that can very quickly erode her surplus. So as an example, I think the OBR reduced, I mentioned the OBR reduced productivity, and that knocked off around 16 billion of her surplus. The reason that it didn't have a massive impact is because inflation was slightly higher than they were expecting, and therefore that boosted receipts and offset that 16 billion. So those are two things that she has absolutely no control of. But based on what the OBR thought and where things moved, it had a big swing in terms of her potential surplus or deficit there. So by leaving herself a little bit more buffer, it allows for things that are outside of her control to move against her without moving her into effectively a black hole.
Just to keep it on the Chancellor for a moment then, got a question. Maybe Ed, you might want to take this one again. And what will the impact of the chair of the OBR resigning yesterday as a result of the leak? What impact will that have on the government and the Chancellor?
Yeah, that's again a good question. That's quite live in terms of what happened yesterday. So for those that aren't aware, Richard Hughes stood down as the chair of the Office for Budget Responsibility. That was on the back of the leak of the budget documentation before Reeves actually spoke. So I think Reeves, well, before I answer that question, I probably should just make it clear that he stood down, but he's made it very clear that they still see it as more of an administrative error. And one of the junior members of staff that released that document, he heads the organisation, so he's fallen on his sword. But it wasn't something that was done purposefully, according to their investigation so far. But what does it mean for Reeves? She now needs to hire a new chair for the OBR. Now she's slightly between a rock and a hard place here. The markets will want to make sure that she hires a suitable economist that can be completely independent and take a view on her policies as they see fit without any government influence. But then from a Labour Party point of view, and this isn't just from a Labour Party point of view, this happened with the Tories as well. they will want a person in charge that potentially looks more favourably on some of their policies from a growth point of view. So at the moment, any of Reeve's growth policies have effectively been discounted by the OBR as not making it a big enough impact for them to change the dial on their forecasts. She wants better forecasts to free up more cash in terms of her surplus, but she has to be very careful that she does that with somebody that markets will trust. If you think across the pond at the moment, slightly different, but Donald Trump's effectively trying to replace Jerome Powell, who heads up the Federal Reserve, with somebody that he knows will cut rates quicker because he wants them to cut quicker. So you run a real risk of markets not liking something if they believe that the person that's being put in charge is not independent. So she's in a difficult position. She's going to have to make sure that hire is right, and we'll hear in the next weeks who she puts in place there.
Thank you. So we're almost at the end of our Q&A session. So I thought, Jonathan, if I could come to you for the final question, any parting advice for brokers?
Yeah, so always the optimist. Educate your introducers. So for example, if you deal with developers, or it might be estate agents, educate them on the innovative products that are out there and the underlying mechanics of the market. Because, for example, if we take track record or delayed start or one of the other lenders' innovative products, that could help create demand for your introducers, and in return then create referrals for you. And even if the customer doesn't end up taking that product, they might not fit the criteria, etc., that customer's then in your customer nurture journey, so that when they do decide to pull the trigger and buy, you're already in there as their trusted advisor because the introduction's been made. Okay, so I would almost be on the front foot and really educate as much as you can, because we live and breathe this stuff. Other people that aren't directly linked with mortgages, or certainly consumers, they might miss a lot of this stuff. So be the trusted advisor. And I would also say change the narrative. Yep, we're all professionals. You sitting in webinars like today, hearing Ed speak, a real expert like Ed speaking about where things are potentially heading next year. Use some of this to change the narrative. A lot of your customers, when they put on the TV, listen to the radio, buy a newspaper, or listen to a podcast, or even just speak to their mates down the pub, the narrative they're getting, it's a bit, interest rates potentially coming down, inflation's still up, will it spike again? There's a lot of uncertainty, but the reality is interest rates, the market's already pricing in base rate to be at 3.5% by mid next year. So it's unlikely we're going to see significant changes in interest rates between now and then. There will be some fluctuations down and up, but unless something major happens that the market's not expecting, rates are where they kind of are today. Also, if you've got customers sitting on the fence, I sort of slightly touched earlier about house price forecasts for the next 5 years. So if customers are waiting, if you've got a customer that's qualified, that they've passed a DIP, so they've met credit score, they've passed affordability, but they're still not ready to buy, or they think they're not ready to buy, are they really doing themselves a favour by not buying now? Is there ever a good time or the perfect time to buy? So yeah, if house prices are going up, they're then going to have to find more affordability and bigger deposits, to then become a buyer later down the line. Another thing, stability is returning. The market's been very volatile the past 2-3 years. Stability is returning. Yes, we're not out the woods yet, but you guys, the mortgage advisors, you are the gateway for the customer, and you can change the narrative. You can be the trusted advisor, and you can hold their hand and help them navigate through the complexities of the market.
Brilliant. Thanks very much. That's all we've got time for. So I'd like to thank our guests today, Ed and Jonathan, and thank you very much for joining us online this lunchtime. Thank you.
Thanks for having us.